The 30-year Treasury yield has just climbed to 5.118%, hitting its highest level in nearly 19 years. For many of you watching this today, that number feels like bad news because it means borrowing money will cost more tomorrow. But here's the real problem. Most people are treating this as a generic rate hike and making financial decisions based on old rules that no longer apply to our current reality. You need to understand why this specific 5.18% figure acts as a critical trigger for 3 immediate actions you should take right now, starting with how it fundamentally changes the baseline return of every other asset class in your portfolio. To grasp what is happening, we must first redefine what risk-free actually means in today's market. For decades, investors operated under an assumption that long-term government debt was a stable anchor yielding around 2 or 3%. That era has ended. The 5.18% yield establishes a new floor for the entire financial system, forcing us to re-index every single goal we set regarding returns and risk premiums. When you hear analysts talk about equity valuations today, they are no longer discounting future cash flows at historical rates because that data is now obsolete. A shift in this baseline creates a nonlinear compression in the present value of growth stocks and infrastructure projects that many people simply do not see coming until their portfolios take a hit. Consider how traditional diversification strategies have broken down under these conditions. We are witnessing a market anomaly where long-term yields rise even as economic indicators show signs of deterioration. This signals a growing fiscal risk premium, suggesting that investors are demanding higher compensation for holding United States debt due to concerns over borrowing sustainability rather than just inflation or growth expectations. Because the bond market is pricing in structural shifts in government finance, we can no longer rely on the historical 46% equity risk premium that guided portfolio construction for so long. The divergence between rising yields and a weakening economy means the traditional flight to safety dynamic has fractured, leaving you with fewer safe havens than you might think. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. This brings us to your first immediate action: locking in long-term debt protection if you have any variable rate exposure or plans for major borrowing. In an environment where the risk-free rate sits at 5.18%, the option value of waiting to deploy capital into risky assets increases significantly. If you are carrying high-interest consumer debt or considering a mortgage, this is not the time to wait and see if rates will drop back down. You must treat this yield as a permanent new cost of capital rather than a temporary spike. By locking in long-term fixed-rate debt now, you create a hedge against the volatility that equity valuations were previously priced on using lower discount rates. Your second action involves shifting your cash reserves immediately from standard savings accounts to Treasury bills or short-term notes. Many investors are still leaving money in high-yield savings accounts paying 2% while missing out on the new floor rate of 5.8% available through government debt instruments. The opportunity cost here is massive and accumulates daily because capital left idle at lower rates loses purchasing power relative to what it could earn risk-free elsewhere. You need to capture this new baseline return before your liquidity erodes in real terms, effectively using T-bills as the primary anchor for your discount rate calculations rather than bank deposit yields that lag behind market movements. Now consider how you must reevaluate the third action: adjusting the risk premium required for any investment other than sovereign debt. If a government bond pays 5.8% with virtually no default risk, then stocks and corporate bonds can only make sense if they offer returns significantly above this threshold to justify their volatility. The historical models that suggested an 8 or 9% return on equities were built on a world where the baseline was much lower, often around 2%. With the baseline now at 5.8% plus, you need to demand substantially higher expected returns from risky assets before committing new capital. This re-indexing forces a fundamental shift in how you view your target portfolio performance and makes patience a viable strategy rather than a failure of execution. The implications for long-term planning are profound because legacy rebalancing rules no longer hold up under this structural change in the cost of capital. When discount rates rise, the present value of future cash flows drops sharply, meaning companies that were once considered growth giants may now trade at values consistent with mature businesses or even lower valuations if their earnings do not accelerate to match the new environment. This creates a scenario where waiting becomes more valuable than acting immediately on impulse. The decision to deploy capital into risky assets is no longer automatic. It requires a rigorous calculation of whether the potential upside justifies the risk when you can earn nearly 5.2% without taking any significant downside exposure at all. You might be wondering how this affects your specific situation, and that depends entirely on where you stand in your financial life cycle. If you are near retirement or rely on fixed income for living expenses, locking into these higher yields provides a level of security that was unavailable just 2 years ago. However, if you are decades away from needing your capital, the volatility introduced by this repricing means you should be more selective about what equity exposure you hold and ensure it is priced at levels that offer genuine value relative to the new risk-free baseline. The key takeaway here is not fear or panic, but a disciplined recalibration of expectations based on hard data rather than hope for rates returning to zero. The confusion between high interest rates being bad for borrowers and good for savers often leads to paralysis, where people do nothing at all because they are waiting for clarity that may never come in the form of old market conditions. The solution is not to freeze, but to act on these three divergent paths. Protect your debt profile, maximize your risk-free cash returns, and demand higher premiums before taking equity risks. By treating 5.8% as the new baseline rather than an anomaly, you align your strategy with the reality of a system that has fundamentally shifted its cost of capital structure permanently. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.